Hello, my name is Terrell Hussein, and I will be reading to you the statement of facts in the indictment of Donald J. Trump, as the indictment itself really didn't say anything. So, let us begin. Supreme Court of the State of New York, County of New York, the people of the State of New York against Donald J. Trump. Statement of facts. Introduction. The defendant, Donald J. Trump, repeatedly and fraudulently falsified New York business records to conceal criminal conduct that hid damaging information from the voting public during the 2016 election. From August 2015 to December 2017, the defendant orchestrated a scheme with others to influence the 2016 presidential election by identifying and purchasing negative information about him to suppress its publication and benefit the defendant's electoral prospects. In order to execute the unlawful scheme, the participants violated election laws and caused false entries in business records to various entities in New York. The participants also took steps to miscategorize for tax purposes the true nature of the payments in furtherance of the scheme. One component of the scheme was that at the defendant's request, a lawyer who then worked for Trump's organization as special counsel to defendant, Lawyer A, covertly paid $130,000 to an adult film actress shortly before the election to prevent her from publicizing a sexual encounter with the defendant. Lawyer A made the $130,000 payment through a shell corporation he set up and funded at a bank in Manhattan. This payment was illegal, and Lawyer A has since pleaded guilty to making illegal campaign contributions and served time in prison. Further, false entries were made in New York business records to effectuate this payment, separate and apart from the New York business records used to conceal the payment. After the election, the defendant reimbursed Lawyer A for his illegal payment through a series of monthly checks, first from Donald J. Trump's revocable trust, the defendant's trust, a trust created under the laws of New York, which held the Trump Organization entity assets after the defendant was elected president, and then from the defendant's bank account. Each check was processed by the Trump Organization. Each check was disguised as a payment for legal services rendered in a given month of 2017, pursuant to a retainer agreement. The payment records kept and maintained by the Trump Organization were false New York business records. In truth, there was no retainer agreement, and Lawyer A was not being paid for legal services rendered in 2017. The defendant caused his entity's business records to be falsified to disguise his and others' criminal conduct. Background. The defendant is the beneficial owner of a collection of business entities known by the trade name the Trump Organization. The Trump Organization comprises approximately 500 separate entities that, among other business activities, own and manage hotels, golf courses, commercial real estate, condominium developments, and other properties. The Trump Organization is headquartered at 725 Fifth Avenue in New York County. From approximately June 15th to November 16th, the defendant was a candidate for the office of President of the United States. On January 20th, 2017, he became the President of the United States. The scheme. The catch and kill scheme to suppress negative information. During and in furtherance of his candidacy for president, the defendant and others agreed to identify and suppress negative stories about him. Two parties to this agreement have admitted to committing illegal conduct in connection with the scheme. In August 2018, Lawyer A pleaded guilty to 2 federal crimes involving illegal campaign contributions and subsequently served prison time. In addition, in August 2018, American Media Incorporated, AMI, a media company that owned and published magazines and supermarket tabloids, including the National Enquirer, admitted in a non-prosecution agreement that it made payments to a source of a story to ensure the source did not publicize the damaging allegations about the defendant before the 2016 presidential election and thereby influence that election. A. The 2015 Trump Tower meeting. 8. June 2015, the defendant announced his candidacy for president. Soon after, in August 2015, the defendant met with Lawyer A, an AMI chairman and chief executive officer, the AMI CEO, at Trump Tower in New York County. At the meeting, the AMI CEO agreed to help the defendant campaign, saying that he would act as the eyes and ears for the campaign by looking out for negative stories about the defendant and alerting Lawyer A before the stories were published. The AMI CEO also agreed to publish negative stories about the defendant's competitors for the election, suppressing the doorman story. A few months later, in about November 2015, the AMI CEO learned that the former Trump Tower doorman, was trying to sell information regarding a child that the defendant had allegedly fathered out of wedlock. At the AMI CEO's direction, AMI negotiated and signed an agreement to pay the doorman $30,000 to acquire exclusive rights to the story. AMI falsely categorized that payment in AMI's books and records, including it in the general ledger. AMI purchased that information from the doorman without fully investigating his claim, but the AMI CEO directed that the deal take place because of his agreement with the defendant and Lawyer A. When AMI later concluded that the story was not true, the AMI CEO wanted to release the doorman from the agreement. However, Lawyer A instructed AMI CEO not to release the doorman until after the presidential campaign, and the AMI CEO complied with that instruction because of his agreement with the defendant and Lawyer A. Suppressing Woman 1's account. About 5 months before the presidential election, in or about 2016, the editor-in-chief of the National Enquirer and AMI chief content officer, the AMI editor-in-chief, contacted Lawyer A about a woman 1, who alleged she had a sexual relationship with the defendant while he was married. The AMI editor-in-chief updated Lawyer A regularly about the matter over text messages and by telephone. The defendant did not want this information to become public because he was concerned about the effect it could have on his candidacy. Therefore, the defendant, the AMI CEO, and Lawyer A had a series of discussions about who should pay off Woman 1 to secure her silence. AMI ultimately paid $150,000 to Woman 1 in exchange for her agreement not to speak out about the alleged sexual relationship, as well as for 2 magazine cover features of Woman 1 and a series of articles that would be published under her byline. AMI falsely categorized this payment in AMI's books and recorded records, and including it in its general ledger. The AMI CEO agreed to the deal after discussing it with both the defendant and Lawyer A, and on the understanding from Lawyer A that the defendant of the Trump organization would reimburse AMI. In that conversation captured in an audio recording in approximately September 2016 concerning Woman 1's account, the defendant and Lawyer A discussed how to obtain the right to Woman 1's account from AMI and how to reimburse AMI for its payment. Lawyer A told the defendant he would open up a company from the transfer of Woman A's account and other informations, and stated that he had spoken to the chief financial officer for the Trump organization, to the CFO, about how to set the whole thing up. The defendant asked, "So what do we got to pay for this? $150?" and suggested paying cash. When Lawyer A disagreed, the defendant then mentioned paycheck by check. After conversations, Lawyer A created a shell company called Resolution Consultants, LLC, on or about September 30th, 2016. Less than 2 months before the election, On or about September 30th, 2016, the AMI CEO signed an agreement in which AMI agreed to transfer its right to Woman A's accounts to Lawyer A's shell company for $125,000. However, that assignment agreement was signed, but before reimbursement took place, the AMI CEO consulted with AMI's general counsel and then told Lawyer A that the deal to transfer the rights to Lawyer A's shell company was off. Interesting. Suppressing Woman 2's account. About 2 months before the election, or about October 7th, 2016, news broke that the defendant had been caught on tape saying to the host of Access Hollywood, "I just start kissing them. Women. It's like a magnet. Just kiss. I didn't even wait. And when you're a star, they let you do it. You can do anything. Grab them by the Gentiles." Sorry. You can do anything. The evidence shows that both the defendant and his campaign staff were concerned with the tape would harm his viability as a candidate and reduce his standing with the female voters in particular. Shortly after the Access Hollywood tape became public, AMI editor-in-chief contacted AMI CEO about another woman, Woman 2, who alleged she had a sexual encounter with defendant A while he was married. The AMI CEO told AMI editor-in-chief to notify Lawyer A. On about October 20th, 2016, AMI editor-in-chief connected Lawyer A with Woman 2's lawyer, Lawyer B. Lawyer A then negotiated a deal with Lawyer B to secure Woman 2's silence and prevent disclosure of the damaging information in the final weeks before the presidential election. Under the deal, Lawyer B negotiated Woman 2 would be paid $130,000 for the rights to her account. The defendant directed Lawyer A to delay making a payment to Woman 2 as long as possible. He instructed Lawyer A that if they could delay the payment until after the election, they could avoid paying altogether, because at that point it would not matter if the story became public. As reflected in emails, text messages between Lawyer A, Lawyer B, AMI editor-in-chief, Lawyer A attempted to delay making payments as long as possible. Ultimately, with pressure mounting and the election approaching, the defendant agreed to pay off and direct Lawyer A to proceed. Lawyer A discussed the deal with the defendant and TO CFO. The defendant did not want to make the $130,000 payment himself and asked Lawyer A and the TO CFO to find a way to make the payment. After discussing various payment options with the TO CFO, Lawyer A agreed that he would make the payment. Before making the payment, Lawyer A confirmed with the defendant that defendant would pay him back. On or about October 26, shortly after speaking with defendant on the phone, Lawyer A opened a bank account in Manhattan in the name of Essential Consultants, LLC, a new shell company he had created to effectuate the payment. He then transferred $131,000 from his personal home equity line of credit to the account. On or about October 27th, Lawyer A wired $130,000 from his Essential Consultant, LLC account in New York to Lawyer B to suppress Woman 2's account. Post-election communication, AMI CEO. On November 8th, 2016, the defendant won the presidential election, became the president-elect. Thereafter, AMI released both the doorman and Woman 1 from their non-disclosure agreements. The defendant was inaugurated as president January 20th, 2017. Between Election Day and Inauguration Day, during the period, the defendant transitioned to his role as president. The defendant met with AMI CEO privately in Trump Tower in Manhattan. The defendant thanked the AMI CEO for handling the stories of the doorman and Woman 1 and invited the AMI CEO to the inauguration. In the summer of 2017, the defendant invited the AMI CEO to the White House for dinner to thank him for his help during the campaign. 2. The defendant falsified business records. Shortly after being elected president, the defendant arranged to reimburse Lawyer A for the payoff he made on the defendant's behalf. In or around January 2017, the TO CFO and Lawyer A met to discuss how Lawyer A would be reimbursed for the money he paid to ensure Woman 2's silence. The TO CFO asked Lawyer A to bring a copy of a bank statement for the Essential Consultants account showing the $130,000 payment. The TO CFO and Lawyer A agreed to a total repayment of $420,000. They reached that figure by adding the $130,000 payment and the $50,000 payment for another expense for which Lawyer A also claimed reimbursement, for a total of $180,000. The TO CFO then doubled the amount to $360,000 so Lawyer A could categorize the payment as income on his tax return instead of a reimbursement, and Lawyer A would be left with $180,000 after approximately paying 50% income tax. Wow. Finally, the TO CFO added an additional $60,000 to supplement year-end bonus. Together, these amounts total $420,000. The TO CFO memorialized these calculations in handwritten notes on the copy of the bank statement the Lawyer A had provided. The defendant, the TO CFO, and Lawyer A then agreed that Lawyer A would be paid $420,000 through 12 monthly payments of $35,000 over the course of 2017. Each month, Lawyer A was to send an invoice to the defendant through Trump Organization employees, falsely requesting payment for $35,000 for legal fees rendered in a given month of 2017 pursuant to a retainer agreement. At no point did Lawyer A have a retainer agreement with the defendant of the Trump Organization. Early 2017, the defendant and Lawyer A met in the Oval Office at the White House and confirmed his repayment arrangement. On or about February 14, 2017, Lawyer A emailed the controller of the Trump Organization, the TO controller, the first monthly invoice, which stated, pursuant to the retainer agreement, kindly remit payment for services rendered for the months of January and February 2017. The invoice requested payment in the amount of $35,000 for each of the 2 months. The TO CFO approved the payment, and in turn, the TO controller sent the invoice to the Trump Organization Account Payable Supervisor, the TO Account Payable Supervisor, with the following instruction: post to legal expenses. Put retainer for the months of January and February in the description. Lawyer A submitted 10 similar monthly invoices by email to the Trump Organization for the remaining months in 2017. Each invoice falsely stated that it was being submitted pursuant to the retainer agreement and falsely requested payments for services rendered for a month of 2017. In fact, there was no such retainer agreement, and Lawyer A was not being paid for services rendered in any month of 2017. The TO controller forwarded each invoice to the TO Account Payable Supervisor. Consistent with TO controller initial instructions, TO Account Payable Supervisor printed out each invoice and marked it with an accounts payable stamp and the General Ledger Code 51505 for legal expenses. The Trump Organization maintained the invoices as records of expenses paid. As instructed, the TO Accounts Payable Supervisor recorded each payment in the Trump Organization's electronic accounting system, falsely describing it as legal expense. Pursuant to a retainer agreement for the month of 2017, the Trump Organization maintained a digital entry for each expense called a voucher, and these vouchers, like vouchers for other expenses, became part of the Trump Organization general ledgers. The TO Account Payable Supervisor then prepared checks with attached check stubs for approval and signature. The first check was paid from defendant's trust and signed by the TO CFO and the defendant's son as trustee. The check stubs falsely recorded the payment as a retainer for 1/1 to 1/31/17. The retainer for 2/1 to 28/17. The second check for March 17th was also paid from the trust and signed by the two trustees. The check stub falsely recorded the payments as retainers for 3/1 to 3/31/17. The remaining 9 checks corresponding to the months of April through December 2017 were paid by the defendant personally. Each of the checks was cut from the defendant's bank account and sent along with the corresponding invoices from Lawyer A from the Trump Organization to New York County to the defendant in Washington, D.C. The checks and stubs bearing the false statements were stapled to the invoices also bearing false statements. The defendant signed each of the checks personally and had them sent back to the Trump Organization in New York County. There, the checks, the stubs, and invoices were scanned and maintained in the Trump Organization's data system before the checks themselves were detached and mailed to Lawyer A for payment. The $35,000 payments stopped December 2017 payment. Investigation of Lawyer A and the defendant's pressure campaign. On or about April 9th, 2018, the FBI executed a search warrant on Lawyer A's residence and office. In the months that followed, the defendant and others engaged in public and private pressure campaign to ensure Lawyer A did not cooperate with law enforcement in the federal investigation. On the day of the FBI search, Lawyer A called to speak to the defendant to let him know what had occurred. In return, the defendant told Lawyer A, "Stay strong." On or about April 21st, 2018, the defendant publicly commented on Twitter, encouraging Lawyer A not to flip, stating, "Most people will flip if government lets them out of trouble, even if it means lying or making up stories. Sorry, I don't see Lawyer A doing that." In mid-April 2018, Lawyer A was approached by attorney Lawyer C, who offered to represent him in the interest of maintaining a back-channel communication to the defendant. On or about April 21st, Lawyer C emailed Lawyer A, highlighting that he had a close relationship with the defendant's personal attorney, Lawyer D, and stating, "This could not be a better situation for the president or you." Later that day, Lawyer C emailed Lawyer A again, writing, "I spoke with Lawyer D. Very, very positive. You are loved. Lawyer D, this is the communication channel must be maintained. Sleep well tonight. You have friends in high places." On or about June 14th, 2018, Lawyer C emailed Lawyer A a news clip discussing the possibility of Lawyer A cooperating and continued to urge him to not cooperate with the law enforcement, writing, "The whole objective of this exercise by the federal prosecutors is to drain you emotionally and financially until you reach a point that you see them as your only means of salvation." In the same email, Lawyer C wrote, "You are making a very big mistake if you believe the stories these journalists are writing about you. They want you to cave. They want you to fail. They do not want you to persevere and succeed." On August 21st, Lawyer A pleaded guilty in a federal investigation. The next day, on or about August 22nd, 2018, the defendant commented on Twitter, "If anyone is looking for a good lawyer, I would strongly suggest that you don't retain the services of Lawyer A." Oh, wow. Later that day, the defendant posted to Twitter again, "I feel very badly for one of his former campaign managers who had been criminally charged," saying, "Unlike Lawyer A, he refused to break. Make up stories in order to get a deal." Wow. Lawyer A and AMI admit guilt in connection with payoff of Woman 1 and Woman 2. Ultimately, the other participants in the scheme admitted that the payoffs were unlawful. In or about September 2018, AMI entered into a non-prosecution agreement with the United States Attorney's Office for the Southern District of New York in connection with AMI's payoff of Woman 1, admitting that at no time during the negotiation or acquisition of Woman 1's story did AMI intend to publish the story or disseminate the information about it publicly. Rather, AMI admitted that it had made the payment to ensure woman 1 did not publicize damaging allegations about the defendant before the 2016 presidential election and thereby influence that election. In August 21, 2018, lawyer A pleaded guilty to a felony connection with his role in the AMI payoff of woman 1, admitting in his guilty plea that he had done so at the direction of the defendant's direction. I messed that sentence up, apologies. On or about summer 2016, in coordination with and at the direction of a candidate for federal office, I and the CEO of a media company at the request of the candidate worked together to keep an individual with information that would be harmful to the candidate and to the campaign from publicly disclosing this information. After a number of discussions were eventually accomplished, the goal of the media company entered into a contract with the individual under which she received compensation of $150,000. I participated in this conduct, which on my part took place in Manhattan for the principal purpose of influencing the election. Emphasis added. Lawyer A also pleaded guilty to a felony in connection with this payoff of woman 2 to secure her silence against the defendant's direction. Again, at the defendant's direction. Lawyer A admitted as part of his plea deal on or about October 2016, in coordination with the direction of the same candidate, I arranged to make payments to the second individual with information that would be harmful to the candidate and to the campaign to keep the individual from disclosing the information. To accomplish this, I used a company that was under my control to make a payment in the sum of $130,000. The monies I advanced through my company were later paid to me by the candidate. I participated in this conduct, which on my part took place in Manhattan for the principal purpose of influencing the election. The statement of facts contains certain information that is relevant to the events described herein and does not contain all facts relevant to the charged conduct. Dated New York, April 4th, 2023. Elvin L. Bragg, Jr., District Attorney, New York. So there you have it. This actually reads a lot better than the indictment. The indictment really didn't say anything. I would say, like everybody else says, hey, please subscribe. But what I really would like is I would like to hear people to comment on what you feel that this document told you, tells you of what happened, and also what's about to happen. I can't say that I'm totally impartial. I do have my own personal opinions, but for the sake of this conversation, I would like to just have people comment with their opinions, and we'll go from there. Thank you for listening.